How's it going, guys? We've had a lot of different misinformation tactics about $14 and $200. AMC closed below $14 on quadruple witching day, and GameStop closed above $200. Does that even matter? Well, we're gonna have to understand a little bit about why does closing at $14 and $200 does not matter, and a deep dive into the actual math behind gamma squeezes. There's gonna be fun charts. I know you guys like photos, and it's gonna be coming from a point of view that loves math. And if you love math as well, and you love the data coming to you hot and fresh on a daily basis, then the subscribe button is waiting for you to join the Moon Platoon Meatball Army. And with that, let's get started. Why does closing at $14 and then $200 does not matter? Let's do this again. You see a lot of confusion about this. First, those large prints you see at the tape at 4 p.m., that's normal. Every day at the power hour, when market closes at 4, the first New York Stock Exchange closing print goes up. This tends to be larger on all Fridays, triple and quadruple witching days due to OPEX. This is not manipulation. This is how the market works. The reason you see the price jump change right at 4 is because you're watching the tick data until 3:59.59, then at 4:00:02, they put up the first closing auction print onto the options component of our class. Obviously, explaining gamma, delta, and dealer hedging and open interest is really not getting through to you smooth brains. They're going to try a practical approach. Use 2 wrinkles you have and think for 1 second. Would the option market work if every time a dealer sold a call option, they just sat around and waited until Friday afternoon to figure out if they needed to have shares to deliver for in-the-money options? Would that make any sense? That people went and bought $200 319 GME options 2 weeks ago for $20, and the dealer just sat in their chair staring at their screen, and at 4 p.m. today, dealers short calls from $125 to $200 went, oh, well, it looks like I'm short $300 million of GME. I have to go buy next week. Of course not. This is what we've been talking about on the show for a long time. Delta hedging. They have to buy the shares essentially as soon as, or if they're feeling a little risky, slightly after the strike price is crossed. When the strike price is in the money, they essentially have to buy it as soon as that happens. This is what delta hedging is. They already have bought stock as a hedge. As the price went up, they bought more. That's the gamma squeeze. As people close their positions on Friday, the dealers are unwinding. Some options will be exercised, and good news for the dealers, they have the stock because they hedged it, right? When they exercise your call options, you're not actually changing the way the price is going to be affected because the stock was already bought. They're just trading hands from the guy who promised you could buy it to you because you're exercising your stock. Options. Second practical point, how many times does this have to happen? How many times do we have to teach you this lesson, old man? How many times does this have to happen before you realize it's not how it works? Every Friday we hear if the stock closes below X, then Y will happen next week, and it doesn't, because quite obviously, if that was the case, you would see huge movements after hours. Spoiler alert, you guys aren't the only ones who can see open interest. Put on your practical hat again. Don't you think if the entire street saw 30 million options in the money and thought that many shares needed to be bought Monday, they would do it now? Options markets matter, and you should learn more because it can illuminate what's happening in stocks, but price at expiry matters very little. There's slightly more to it. You can look at pin risk and max pain if you're interested. I'm trying to be the most basic concepts across here. If you guys are curious about pin risk and max pain, go ahead put a scissors in the comments if you want to learn about pin risk, and put some diamonds in the comments if you want to hear about max pain. We want you to guys collaborate, vote with your comments in the comment section below. The reason AMC traded in such a tight range is because it got pinned at the $14 price due to large OI. This is not manipulation and is just due to mechanical hedging by dealers. So this kind of flies in the face with a couple of the different thoughts that we have had in the past, such as when Trey came on just yesterday and talked about short walls. However, this may be a nuance in here of learning from one side to another. Just remember that ending the price at a certain price may not carry as much weight, just like how we thought beta was a big issue and -2, -8 beta for GME was a huge thing, may not be. So once again, take the DD, even this one, with a big grain of salt. And once again, like that DD said, education, knowledge, it's key. So luckily for you, we're gonna go and now deep dive on the actual math behind gamma squeezes. If you guys heard about that gamma squeeze explanation that just took two sentences, now we're gonna actually visualize it for you with pictures. So make sure you watch to the end. Hi, Wall Street Bets. I've seen a lot of people talking about gamma squeezes recently, but I haven't seen anyone explain the math correctly. In fact, even the recent Forbes article got the concept wrong. Remember, we read both of those Forbes articles. So I figured I'd sit down with this fine Saturday morning and put together a post on the actual mathematics of a gamma squeeze. So we're going to talk about options concepts such as the Greeks, and I won't go into so much detail that you'll need to understand the Black-Scholes equation or anything, right? We're going to make it easy for you guys to understand. First of all, let's look at the market makers. The first thing you need to understand is who is on the other side of your trade when you buy a call option, right? Time, a call option, just like Robinhood has put on their suspiciously juvenile education website, is like fruit. Sometimes you go buy fruit and it's no good when it expires. So you cannot pick the fruit from the tree and you lose the cost of the seeds. But sometimes they are good, as in the money, their strike price is lower or higher, depending on the put or a call, than the price of the stock. And then you can harvest them, execute them, right? Also like a coupon. Robinhood legitimately, I'm not even joking, makes it seem like a fun little coupon you might go to the grocery store with, and then they say, hey, you might be able to use this coupon if you think it's a good deal. However, if another grocery store down the street is making the price of the fruit that you want to be able to buy cheaper than the price of this coupon over here on this grocery store, you're probably not going to use that coupon. So once again, this is what a call option is, a promise that someone will sell or buy that stock on your behalf, but you do not have the obligation, only the option to execute it. Typically, this is not some other trader or hedge fund that wants to inverse your bet. Instead, the counterparty is what we call a market maker. Market makers profit from providing liquidity to markets, not from taking directional positions, right? They don't want to make the bet that you are making. They just want to be able to take their money and make more money with money. Did you know you could do that? In practice, what this means is that market makers charge you a slight premium and then position themselves so that no matter what happens, their premium is preserved. This position is called hedging. How market makers hedge call options. There are infinite ways that market makers could theoretically hedge against the calls they sell. However, by far the simplest and most prevalent way is to buy some amount of shares of the underlying stock. Remember, one option contract equals 100 actual shares, right? 100 actual shares. Options here is confusing because, right, remember, options also refers to the option itself. However, here's the part that they think that they are misunderstanding. Market makers do not have to buy 100 shares of the underlying for every option contract they sell you. It's bold. Drill this into your head. This would not be a hedged position. This would be equivalent to the market maker having covered a call on a stock, which is a bullish neutral position, and will lose money if the underlying declines. The last thing a market maker would ever want to do is take a bullish position on a meme stock that they are selling you options on. Essentially, it's like the horse race analogy. You go to the bookie and you say, put $100 on the fact that I think Mimi McGee is going to be first place next week. That is the idea of a call option. And then the bookie looks at you and says, all right, give me some premium, give me the money. And then they just do nothing. They take your money because they don't think Mimi McGee, the horse, is going to be able to win next week. That's way too soon. So that is exactly the point. Let's see. So this is the last thing they want to do. They don't want to take a bullish position on a meme stock. So how does a market maker actually hedge? To understand how market makers actually hedge, first you need to understand two options concepts, delta and gamma. Delta is delta of an option represents how much of the option would increase if the underlying increased by $1. So a delta of 0.3 means that for every $1 the underlying stock moves up, the option will go up 30 cents. Remember that the initial price of here, let me just make sure you guys can see this chart here. Maybe not, not quite yet. Okay, remember that the initial price of the call option is much less than the stock, so that 30-cent increase is a much higher percent increase than the corresponding increase in the stock. If that hurts your head, keep on listening. As an example, you may have paid $10 for a call option with a $100 strike on a stock that is currently trading for $50. If the delta on this position is 0.5, then the stock moves up to $51. The option will be worth $10.50 or so. So the stock moves up 2% and the option moves up 5%, right? It's just a linear relationship here. A key thing to note about delta is that it's not constant. It varies based on the changes of the price in underlying stock. In fact, you can see the chart below. The delta is lowest for the deep out of the money calls and highest for the deep in the money calls. So when I said linear, it really is this weird squiggly snake shape right here for the call delta. We have down here in the x-axis the strike price, and right here is how much delta there is. Delta as a function of strike price. Without going too much into technical detail as to why, just note that this makes intuitive sense. If a stock is worth $100 and you have an option to buy it for a strike of $1, right, deep in the money, then the option should be worth $99 and basically move exactly in tandem with the stock. Whereas if you have the option you paid $1 for, which gives you the right to buy that same stock for a strike of 1,000, delta has to be really low, because the chance of that happening is going to be really, really low. Otherwise, say delta was 1, every small 1% change in the stock would cause your options price to double, right? Gamma. Gamma is closely related to delta. Gamma represents how much delta changes as the underlying stock moves up or down. So in the chart below, gamma is the slope of the curve. In fact, if you know calculus, the simplest explanation of delta and gamma is that delta is the first derivative of the option price with respect to the price of underlying stock, and gamma is the second derivative. If that's confusing, hey, easy way to understand calculus. I'm just going to bring you up to a PhD level real quick. Think about your position, right? You're standing in your underwear in your bedroom, and that is where you currently are. If you walk to the bathroom or the kitchen, that is changing your position. Depending on how fast you go, right, just like in a car, that is your speed. That is the first derivative of your position. And then the second derivative of your position is your acceleration, right? Just like in your car, when you vroom vroom the gas pedal, that how much you vroom the gas pedal changes your speed, and that of course changes your position as well. So that is an easy way to understand exactly the first and second derivative relationship between gamma, which is the second derivative, delta, which is the first derivative, and the option price, which is the base position where you are. While delta is highest when calls are deep in the money, gamma is actually highest when calls are exactly at the money. You can see this by noticing that the slope of the curve in the graph above is steepest at exactly the strike price, $300. The slope is gamma. The graph shows this even more clearly. The red line is delta and the blue line is gamma. So once again, with that analogy in tow, look at this visualization. Pretty pictures are easily a little more clear. We have the gamma right here with its highest point right here. This is where gamma is highest, right around the middle of the call delta right here. And this kind of makes sense as well. You kind of have to accelerate the gas pedal the most when you are roughly halfway through accelerating the car. Right? Then you put your gas off because it suddenly is not as necessary when your car gets up to speed. This is why fuel efficiency, if we're still with this car analogy, is best when you're already traveling on the highway at a high speed. Delta neutral strategies. Okay, so now we're ready to understand how market makers hedge. Market makers employ delta neutral strategies. This means that their overall position will have a delta of 0 with respect to the stock price. A stock always has a delta of 1 with respect to itself, of course. So how do they do this? They do this by selling you a call option and then buying just enough shares to maintain a delta neutral position. They then constantly adjust their position, buying more or selling more shares as the delta of the option increases or decreases. They can do this because they are large institutions who can trade quickly with little cost. Best way to understand this was an example. GME was trading at $137 2 weeks ago. You buy March 19 $150 call options. Of course, those would be in the money, which is currently trading at $26. So right now, let's do the quick math if you did that, right? $26 with a closing price of $200. If you exercise, that means that you make $24 per share. Because the premium per stock is this, you get to buy it at $150 and you get a $50 profit after taking off $26 premium. That is a net profit of $24 or change. Greeks. We got delta, we got gamma, rho, theta, vega, and imp vol. Okay. A market maker takes the other side of this trade, and they say, this seems possible. You know, maybe I will go ahead and let you have this trade. But however, if you made this trade and they didn't cover their options, that profit you made, $23 times 100, so it's $2,300 per contract, they would be down $2,300 a contract if they didn't cover, which they most likely did. When they sell the option, they now have a delta of roughly 0.5 for each option. And since options contracts trade in groups of 100, their overall delta is 49.8, negative 49.8 or negative 50 for simplicity. In order to be delta neutral, they need to balance this position with securities that have a delta of 50 with respect to GME. The simplest way to do this is to buy shares. Each share of GME has a delta of 1 with respect to GME, so the market maker buys 50 shares of GME. Now their overall position is this. Position equals, I'm ready to do some algebra, 50 times GME shares minus 1 times the GME March 19th 150 call options contract. And their overall delta is negative 50 plus 50, 0. Perfect. They hedged. Delta hedging at its finest. There are two important things to note about this. One, the market maker wasn't forced to buy 100 shares of GME. Like I've seen many users on here claim, instead they will only buy 50 shares. Your trade costs you $26.73 times 100, right, $2,600, and caused the market maker to buy 137 times 50 shares worth of GME. That's approximately 2.5x leverage. If you wanted a video about leverage, let's see. We already have scissors and diamonds down in the description. Let's make those gorillas. You wanted to talk about leverage? Comment a gorilla down in the comment section, or if you just wanted to use your actual mouth and use human language, then you can comment in English and you don't need to use emojis. Thank you, Josh, for the super. I'll comment in a second. Market maker repositioning. Remember that as the stock price moves up or down, the delta of the option that the market maker sold you changes, right? They have to buy more shares as it gets closer to your strike price, and even especially when it gets above your strike price. The market maker wants to maintain a delta neutral position, so they will rebalance their position by buying or selling shares. Let's continue with the example above and assume that GME has gone up $2 and now trades at 139. According to the Greeks in the table, the new delta is blah blah blah, which is slightly higher than the 0.49 and change they had before. Remember that there are 100 options in the contract, so the delta of the contract is now 51.34. So they actually have to now buy another 1.34 shares of GME. Market makers will thus constantly adjust the number of shares they are holding in order to maintain delta neutral positions. As the price goes up, there's a mathematical equation, an algorithm that just essentially says, hey, it's time to buy more shares just because I don't want you to lose money, you little hedge fund, you. Ooh, do. Here you go, you little hedgy. I'm gonna give you a head pat. Okay, I'm feeling a little silly because this video is a masterclass in understanding what the gamma squeeze actually comprises of and how market makers are positioning. That's why this is the art of war. Understand your enemy better than yourself right now. Okay, so market makers are incurring some cost doing this because the more volatile the stock is, the less quickly and efficiently the market makers can hedge. Imagine that they knew that the stock is going to go up to $200, right? They definitely would have just bought all 100 shares right now, because then they'll be in the exact same position as you, and you get to pay a premium for the opportunity to make $2,300. They actually make the full $70 times 100. They make a full $7,000 and only pass on $2,600 of profit to you. So in that sense, they are much happier with that, but only if they have a crystal ball, and none of us have one, unfortunately. But they still make money overall because they've charged you a premium for the option that takes this into account. This is why they charge you a higher premium for volatile stocks, GME, AMC, gamma squeezes. Now that we are finally in a position to discuss gamma squeezes, now you understand how market makers hedge, so the rest is very simple. As the underlying stock goes up, the market makers that have sold you call options will buy more stock in order to maintain a delta neutral position. The amount of stock they have to buy is proportional to how much delta of the options changes, which is just gamma. And gamma at its highest when option contracts are at the money. And so when there are a ton of call options on the stock, Price increases in the stock can cause market makers to buy even more of the stock, and the rate of buying is highest when the option contract is at the money. This is the gamma squeeze, the snowball that rolls through all of the snow faster and faster and makes us get to that margin call for the short squeeze to be triggered ever so quickly. Notice that the inverse is also true. When the price decreases, the delta of the options decreases, and the market makers also now have to sell stock in order to maintain delta neutrality. So what does all of that make you think, right? Does it make you feel a little bit stronger about exactly how your grasp on the market has actual consequences for the end day to day? That's something I want you guys to come away with, right? This masterclass on call options was brought to you by that subscribe button. Make sure that you hit that subscribe button nice and tight, because we are going to continue making these masterclass simple to understand for apes, simple to understand for simple beginners, and using GME and AMC as a catalyst for your educational purposes. If you want to start investing in yourself, that subscribe button and that bell button is waiting for you so you don't miss a single live stream. We go live every single bell to bell, and I don't think you want to miss out on next week's crazy shenanigans, especially since we have the earnings report as well as a couple more catalysts for GME and for AMC as well. If you guys like this video, of course, we always appreciate your like and a comment about exactly what you are looking forward to see in a future video. Let's give it up to these patrons. Of course, without these people, the subscribers that have pressed the join button next to the subscribe button, and the people that have gone down and checked out the Patreon, this show would just be that much more hard to make happen. So thank you guys for supporting the show. If you are also interested, that's one of the easiest ways to pass a couple of bucks along the way. Buy Meatball and I a coffee and a treat, respectively. And for now, but not for forever, I will see you on the moon. Peace.